Stephen is right beside me here. Stephen Wood, he is Chief Market Strategist at Russell Investments. Steve, glad to have you. We should mention Russell has about $160 billion. That's what you help to manage with your team. What does all this turmoil in Europe mean for U.S. stocks, for the average person, 401k that's watching this and doesn't understand the correlation?
What we've seen is flight to quality, flight to safety. With all this turmoil, every time things get choppy overseas, people come to the U.S. So all the talk about the dollar and the U.S. economy, we're still a pretty good story. So I think what you've seen year to date is, while the United States...
Year to date, the S&P 500 is barely, I mean, it's up 0.5% year to date.
It's up. And you know, the Russell 1000, Russell 3000, they're up, as well as the S&P 500. So year to date, the United States is really weathering the storm a lot better than other options. Other than Germany, we're the
perceived
safe haven, so the major economy that's been doing well. We're up against Canada, up against France, up against a lot of alternatives.
So I know you think the S&P 500 goes up, even though we're up only 0.5% right now year to date. You say we're actually going to end up 9% higher from here.
Correct.
So what's going to happen in the second half of the year that's going to make the S&P 500 gain 9%?
It goes a little bit like this. You got two sides of the equation. You got unemployment, you got oil, which look really bad, and housing, which is going to continue to look bad for the foreseeable future. Underneath the radar screen, however, you still got corporate America's doing extremely well. The economy's slowing, but companies have gotten so lean, so mean, so efficient that in a 3% GDP world, they can be as profitable as they would have been like in a 4 to 5% world a little while ago. So look at companies, look at profitability, and when the market recognizes that, we think, you know, mid to high single digits could do okay.
But to go further in your reasoning, if we didn't hit 3% growth, then what happens to the target? You pull it back?
It's a pretty conservative target. You were looking at other shops, and we'll leave them nameless, that we're looking at 1450, 1500 on the S&P. And we're sticking with what we thought was a reasonable multiple on reasonable earnings. We still think we can hit it. Oil's coming down. The consumer's paying down some debt. I don't think things are going to be fantastic. I think they're just going to be okay. And in an okay environment, you can get an okay return. So
speaking of okay returns, where does an investor have the best chance to get the best for his or her money?
I think just going passive right now is probably not going to cut it. You need to cherry pick. You need to do your research. There's certain areas in the consumer, and I can't talk specific stocks, but our managers are going through consumer areas. We're also looking at some financials, and now that we've got a little bit more clarity in financial regulation, well-capitalized, good business models, I think also you're seeing in energy, maybe not the integrated so much, but if you're looking at extended long-term capital plays in energy and even cherry-picking in technology, I mean, there's a lot of opportunities there.
There's a lot of opportunities, but I heard what you said. You have to do specific research, a lot of homework for companies. You can't just pick sectors. Are there ones, though, that in general you can say sectors to avoid?
Well, utilities we haven't liked for a long time, and I would also think very cyclically positioned companies right now you want to be a little cautious on. I mean, sprinkle maybe a little healthcare
and that's because of the concern about the U.S. growth slowing.
And global growth slowing as well. China is really hitting the brakes hard. So I think commodities right now you also want to be a little bit cautious on. We'll hold gold to the side. Commodities right now have been getting soft because the global growth story is slowing down. China is not going to be this voracious consumer in the next year or so as it has been. So emerging markets, commodities, short term are going to be choppy. I think there's going to be a lot of headwinds there, and I think that helps the U.S.
All right, Steve, thanks so much for coming in. Good to see you. Stephen Wood joining us, Chief Market Strategist with Russell Investments.